Welcome to the Fund Expert Talk. I'm Mike Mbayi, Head of Banking and Finance at Praxio. And today I have the pleasure to welcome Kristina Kulikova. Hi, Kristina.
Hi, Michael. Thanks so much for having me on the show. It's a pleasure.
Our pleasure. First of all, can you please further introduce yourself, your firm, and your role at the firm?
Yeah, absolutely. So my name is Kristina Kulikova, as you alluded, and I'm the Senior VP on the LP advisory side for Setter Capital. Setter Capital is a Toronto-based but global secondary market advisory firm. So we've been around since 2006, way before secondaries became really a big deal. And we operate across LP advisory, we have a GP-led team, and we have a structured solutions team, as well as venture capital private market trading desk. So we cover it all.
Mhm. And you really built like an impressive career in secondaries. Can you maybe let us know, or have you been interested in the topic and walk us through your career path?
Sure. I think there's, I first I was at Unicash, which is a really small FX firm during my university years. And then after graduation, I went to Bank of America in their banknotes operations department, but it was back office. And I very quickly realized that I'm much more of a front office person, and I like speaking with people. I like deal execution. And so when an opportunity arose and I saw a posting on LinkedIn for Setter Capital, I applied. I had no idea what I was applying for. I had no idea what secondaries was. Had no idea what private capital probably even was.
Sure.
I mean, outside of my university knowledge. And so that's how I started. And honestly, I've been here almost 12 years and never really looked back. It's been a journey, starting as an analyst and working my way up to senior VP. I now am very grateful to have a team behind me that I oversee and whose help I'm extremely grateful for in making, deal execution smoother and fruitful and et cetera. And so it's been really a ride and it's been a pleasure. But secondaries have come a long way since 2014, which I'm sure we're going to talk about quite a bit. And, they used to be an adjacency to private and capital markets. And now they've really become a major force in the evolution of sort of portfolio management and private assets as a whole in private capital today. So I'm extremely blessed to be part of this industry.
Mhm. And Christina, sometime in career there are like pivotal moments. I think would say important moment which we see changing everything for the rest. Are there some pivotal moments in your career or pivotal mentors or reference that you can share with us?
So I come from actually a competitive ballroom dance sport career that I've carried pretty much throughout my life and into university and my initial years at Sutter. And so I was a Canadian finalist and North American semifinalist, and that really taught me the value of, hard work, motivation, and most importantly, being responsible for your own results. And Peter McGrath, who's the founder of Setter Capital, strongly embodies all those values. And I think that's what impressed me the most when I initially joined the firm. And what has kept me here and continues to inspire is really his never-ending motivation, very strong work ethic, and a desire to be unstoppable. And he encourages that in everybody. And I think that's what drives and inspires the firm and continues to push us to improve. And so I think he's been probably the biggest influence on my development.
And if you had the possibility to go back in time and speak to your younger self and with all the experience that you have earned during the years, what would be the one or two advice that you would give?
I think for the most part, we all do what we can and the best that we can with the circumstances that we're in at the time. So at least I'd like to believe. So I don't think that I would have done things differently. But I think as cliche as it may sound a little bit, don't worry so much about getting it right the first time. We're not meant to be perfect from day one, and otherwise we have no room to grow. And it's actually, kind of great to be bad at something, so then you can improve and see yourself improve. And I think for the longest time, that was a personal hurdle I had of just trying to be the best at right away from day one. And then you realize that there's really no room to grow if that's your mentality, right? And you can't. So that's probably it.
That makes sense. And you're also the host of the podcast Women of Secondaries. I would be interested to know what was, the drivers behind that idea and what is the purpose of that podcast.
So it's funny you asked that question, because when I first came to Sutter, I was the only girl on the team. And, someone said to me, the last girl that was here, she didn't last even 3 weeks, so good luck. And I took that as a bit of a personal stab. And I said, you know what, I'm going to prove you wrong. And, 12 years later, it's fantastic to see how much more women are in this industry and how much more senior and incredible women who are actually driving the market, really. And that's the tagline of the Women of Secondaries podcast is, the women behind the innovation and the performance of the industry. And I think it was really a passion project that I got excited about. In profiling these women and getting their market take. And Peter at Sutter really supported the initiative, said, go for it, it's a great idea. And we linked arms with Secondary Link, who loved the idea. And so that's how it, started. And I've really gotten to know some fantastic people on the show who are not only incredibly hardworking, very smart, and innovative. And I think it's great to have the chance to pick their brain.
And you have interviewed a lot of leaders then through that show. And is there any advice that you are keeping for yourself?
I think every show that I've done and every lady that I've interviewed, I've walked away feeling more energized about the industry, more passionate about the industry. And everybody that I've spoken to actually fell into secondaries completely by chance, just because it was so new at the time and they had no idea what they were going in for. And they took the step and actually spearheaded whatever it was in their industry that they were doing, right, or at their firm. Like whether it's Valerie Handel from HarborVest, she was there at the inception of GP-led deals or sort of CV-led deals. Or Sarah Cardiff from CFC, she was one of the sort of pioneers for reps and warranties insurance and secondary deals. Or Agnes Tang at AB Value, she spearheaded the inception of the Asia-based secondary fund. And so it's just, don't be afraid to do something new and to do something out of your comfort zone, and you'll grow and you'll do better as long as you're passionate and excited about what you're doing. That's probably the biggest lesson that I keep learning from all the women.
So you are leading experts in secondaries. So for people new to secondaries, I would say secondaries 101. So what is the purpose of a secondary transaction and what are the benefits for the different parties?
Sure, yeah, happy to do sort of a basics overview, but the purpose is to really allow investors to exit the investment prior to the end of the life of the fund or a natural exit, allowing them to unlock earlier liquidity and better manage their portfolio cash flows and inherently return. So for example, they may look to crystallize a gain in the uplift in the NAV versus their cost, assuming of course the buyers pay the price as such. Or they may want to return their cost basis, right? If they've seen that the fund isn't performing, they want to try to get at least their money before NAV deteriorates, or there's been limited distributions and they're looking for liquidity. And that's the other one, right, is of course liquidity management. But the other one is relationship management. So a lot can change in 10 years, and perhaps the strategy started in the past either by the GP or by the LP themselves is just not core anymore to the group. And so the secondary market allows them to take control of their relationships and get out of their no longer core GPs while reinvesting that capital into GPs that they would like to support at this point and that better align with their strategy going forward. So that's from an LP perspective. For GPs, they can use it to also shuffle their LP base, reshuffle their LP base. They can, assist LPs with exiting their investments. Perhaps those LPs, again, no longer feel aligned with the franchise, and the GP can accept new investors who could do future co-invest deals with them, or even primary commitments, right, to that GP. And so if the GP is running a tender offer for their LPs, it allows the GP to offer liquidity options to their investors in lieu of distribution sometimes, and also strategically position their LP base as well. And then also, of course, the rise in CV deals, right? It allows GPs to hang on to their strong assets for longer instead of having a competitor maybe buy their assets and get all the return from it on go forward. They can hang on to it. They can inject a bit more capital in it through a CV and hold it longer towards a stronger exit, while also offering liquidity to those LPs that may want that distribution, right? So it's quite flexible for all. And then I would say if you're looking at it from a buyer lens, it's a shorter duration investment than a primary deal. And so given that buyers typically will buy later in life of the fund, or at least halfway through the fund, there's more near-term distributions. They're avoiding blind pool risk, which is why particular buyers like fully funded investments usually, so less unfunded. And then oftentimes buyers will use it to backfill exposure to a GP. So let's say they missed a vintage, or they wanted to commit and they didn't have capital at the time or whatnot. And this is sometimes for non-traditional buyers like pension funds we see coming to the market, where they're using the secondary market to backfill the exposure. And so, it helps for secondary buyers and kind of non-traditional buyers, it helps manage their portfolio IRR and MOIC hurdles in a way that's almost self-directed, right? Because they can dictate the age of the fund that they buy and the price at which they ultimately buy that fund or portfolio, and they kind of better understand the profile of anticipated distributions going forward versus sort of hold periods. So there's definitely advantages for all stakeholders involved.
And you are advising a lot of LPs on those type of transactions. And how differs GP-led secondaries vis-a-vis LP-led secondaries in terms of process, risk profile?
So I can start with the LP process first, just given that that's my world that I live and breathe every day. We do have a GP-led team that can dive into the GP-led details, but I'll cover the basics. And so I think with the evolution of the secondary market and where it is today, both LP and GP-led processes have become more and more standardized, which is fantastic because it helps decrease execution risk, it improves pricing transparency, it lowers cost oftentimes, right? Speeds up timeline for close, et cetera, et cetera. And so typically for an LP selling, it includes 3 stages. There's the pre-analysis stage, the marketing stage, bidding stage, and closing stage. And in the pre-sale analysis stage, an initial evaluation of the portfolio is done to determine approximate pricing as well as maybe optimal subsets to sell. And at Sutter, we provide what's called a Sutter liquidity report to understand line-by-line pricing, maybe what subsets, again, could be saleable. And then the client kind of takes it back and considers what is best to bring to market, or maybe now is not the right stage to bring something to market. And let's say they decide to progress, and then we get into the marketing stage, which is where the seller will link arms with the agent. The agent sets up the process, and that'll entail targeting the right buyers, setting up the data room, liaising with the GP to allow information sharing under NDA requirements set by the GP, and then setting the bid deadlines, of course. And then during the bidding stage, often between the first and second rounds, we will assist with GP calls for due diligence if it's something that they allow. And then that's where the negotiation on ultimate pricing maximization takes place. And, we determine certainty of close based on various parameters, GP approvals and capital needs for buyers, et cetera. And then once the final bidder is determined, the GP is made aware that we should initiate the closing process, and that's where you have your PSA negotiations, transfer agreement negotiations, KYC, and then ultimately leading to the transfer of the funds. So that's if I sort of frame the process in a very step-by-step sort of way. It's much more nuanced than that, but kind of the high level. And so within that process, the risk that an LP may have, which is actually important to consider for all parties involved, is number one, sort of the price mismatch, right? Because it is very likely let's say you'll go to market, and if you haven't looked at the pre-analysis stage, or you haven't sort of taken the time to do that, or maybe the market's shifted or it's a fund that never comes up in the market, and so there's little visibility into what ultimate pricing might come back as, that's a risk, right? You might just have a mismatch and spend a whole bunch of time without selling. The other one is GP approvals. So you may have a bid from the best buyer or the highest bidder, and the GP will not approve them. And it happens all the time as GPs try to control their LP base a little bit more. And we try to mitigate this on our side by really knowing who are the groups that would be approved by the GP. And we've that very detailed for that. We may spend a lot of time there to ensure that there's not disappointment like that at the end of the process. There's also the ROFR risk, which is the right of first refusal risk for LPs in it's more sensitive to portfolio deals, I would say, but there's also easier ways to mitigate it in a portfolio. But let's say the biggest NAV driver in the portfolio deal has a ROFR, and that ROFR gets triggered by a party that's not the buyer. Well, that causes issues for the buyer a lot of the times, because the composition of the portfolio they were hoping for is no longer the same.
Sure.
There's ways around it, but still it's a kink in the process. And then one of the other two main ones for at least LP processes would be PTP limitations, so publicly traded partnerships for US funds, right, where you can't transfer more than 2% of committed capital in a given year. And so oftentimes, actually with the momentum that secondaries is having, funds are reaching those PTP limits faster. And so for transactions that are in the second half of the year, oftentimes we do see PTP issues arise, which can have issues on the seller because they ultimately have to now wait until the following year, and that triggers an additional accounting year. It may trigger, keeping the fund open if they're winding down a vehicle. It may trigger delay of receiving the purchase proceeds, essentially, or the sale proceeds rather. So that is a risk. Sometimes we like to get ahead of it earlier, but not always feasible. And then the last one I'll just mention very briefly is sort of ECI tax withholding considerations. Sometimes if it's a non-US seller selling a US fund, the buyer really has to make sure whether there is withholding tax applicable to them or not. And there's, now thankfully we have reps and warranties insurance that can insure against that, but that often is a risk that you run. And again, better to get ahead of it earlier rather than later in the process. So hopefully that sort of summarizes, the LP part of the equation and the risks inherently with the LP process. And you wanted me to touch on the GP LEDs as well, right? So on GP LEDs, it depends on what type of process the GP is conducting for the most part. Is it a multi-asset CV? Is it a single asset CV? Is it a syndicate buyer pool or a single buyer that's leading the CV or executing the CV? And the process is similar in that the GP has preliminary discussions with agents, right, in the market so that they can understand, is this asset going to have demand? Does it make sense to bring this to market now? And will it be at the value that we believe will garner LPAC approval? Because all the CV deals, they require LPAC approval. And then they would hire the agent. The agent would market the transaction. Once, let's say, a terms setting buyer is determined, it's important to understand how the transaction would be financed. Is it all from buyer capital, or will fund level or transaction level loan be used to fund part of the deal? Is that who is that loan being set up by? There are a lot of nuances too, such as how management fees and carried interest is structured in the CV. Let's say what happens with distributions in kind, clawbacks, recallable distributions. Which is really best to iron out earlier in the process. And there are many points of negotiation with the stakeholders as well as with buyers, I would say, as well as existing LPs. Given that LPAC, again, LPAC approval will be required for this, it's best for the GP to speak with their largest investors early in the process to ensure that there's buy-in for that transaction generally, because I think the highest risk for a GP is them progressing too far into the process without actually proper communication to their LPs and their LPAC, really detailing out the terms that are contentious. And by that point, they could have incurred costs and they had a whole bunch of time sunk into this transaction. And ultimately, the LPAC doesn't approve it. And so that's a risk that is real for both the GP and the buyers involved. So for a GP, it's really important to know that they're going to have LPAC buy-in and to share those details and communication early with their biggest LPs at least.
And when you are advising LPs for selling their stakes, what is the factor which has for you the biggest impact on pricing?
There's several. So first would be the GP valuation of the assets, right? So the marks at which they hold these assets. Are they using stale sort of 2021 top of market valuations? And then sometimes different GPs will hold the same asset at different marks. And so a buyer that, let's say, is invested into both GPs, they'll have visibility into that, and that will dictate how much of a haircut they apply to the GP valuation. The number of assets in the fund and its concentration, some also, and sort of the what is their concentration in? Is it in their best performing asset? Is it in their least performing asset? So that oftentimes also dictates pricing. I would say fund level debt. So if there's a facility taken out at the fund level, that'll have implications depending on at which point in the fund life cycle the facility was taken out and the record date off of which the bidder is bidding on. If there's a large facility, how much of the repayment of the debt will affect the pace of distributions, the amount of distributions, the timing of the distributions. So that would be taken into consideration. DPI rate to date, obviously, if you have no DPI and it's late in the fund, there's concerns about how efficient is the management team, what is their path to exits for their investment. If the DPI is very high and they've done a great job of exiting these assets, that might also impact pricing negatively, because how much go forward upside is there for a buyer that's going to step into that fund after the GP has already crystallized, as much distributions as they have. So it's a balancing act. Where you want to be somewhere in the middle where there's still value creation, but you see that there's been a path to exits. And then vintage year for later in life funds, how come these assets are still remaining in the portfolio? Maybe they should have been exited earlier. Are they challenged assets? For younger funds, also how much unfunded remains, or how much unfunded remains? What is that unfunded being used for? Is there a plan for the unfunded? Secondary buyers don't like blind pool risk. That's why they participate in secondaries, and so that will oftentimes dictate pricing as well. And then lastly, I would say, well, amongst other factors, but the main ones is the quality of the GP. Marquee GPs, top quartile GPs will generally yield better pricing, unless there's incredible performance at the portfolio company level for emerging GPs, for example. But there definitely is a bias towards higher pricing for marquee GPs.
And if we talk about due diligence, what are the more overlooked points from a GP, from an LP perspective regarding due diligence?
Regarding due diligence for like GP-led deals, when a LP is considering participating?
Indeed.
Yeah. So a lot of times, these are, I guess I'll phrase it as in a way which points you want to pay attention to when you're doing your due diligence. And it is possible to overlook these points because oftentimes there's not a lot of time given to evaluate these GP-led deals. Like I think ILPA recommends 30 calendar days, which oftentimes could be like 20 business days, right? So it's not a lot of time, especially considering if an LP has a really large portfolio and there could be multiple CDs at the same time that they're evaluating, or they have a small team, right? It becomes difficult, and so things can be overlooked. But I think carry rollover is a big one. Really truly understanding how much sort of true risk is the GP actually taking. Are they only rolling kind of their out of money carry, or are they contributing real capital? So they're putting more skin in the game. And it's really important to diligence the new economic terms, if they include any step up in carry or resets of preferred return. So all those things that can impact an LP's go forward return. I think also assuming too much about the quality of the assets. So past performance is not always representative, right, of future performance. And is the asset being set up for a CV because it's truly undervalued, or because it's the only way that this can be sold, or the GP can get carry or whatnot? So you want to always examine whether the GP's evaluated other pathways to a sale or to a CV, and if so, why did that fail, or why were other avenues not considered, right? So kind of asking, is this asset actually set up for a CV, and why is that CV being done? And then I think scrutinizing the information that the GP provides closely. So is there any information asymmetry between maybe the buyer, the GP, and the LP? Has the GP disclosed all the details about the process, the buyer, the setting of the terms, their involvement with it? Was there a fairness opinion that was provided or sought? And if there isn't adequate information presented, or not enough time really given to evaluate it, and there's a bit of pressure, like always ask questions, right? I think that's the biggest thing. If you feel like something's missing, you should always raise your hand. And then lastly, valuation, right? Was there a full process run? Was there, again, a third-party valuation firm? Are sale valuations being used to justify maybe step-ups that will later inflate GP performance? So that's a big one to also look out for. So I think those are, again, our GP-led team would have a much better, more detailed answer for you, but I think those are some of the sort of high-level parameters that are important.
Thank you. And when you are advising LPs, there is sometimes concern about conflict of interest. I don't know if you can give a few more about that.
So it's a conflicted transaction in general, right, for CV deals, because you have the LP that is potentially needing to decide to sell an asset when they weren't thinking about selling an asset, and so and then they're also becoming almost secondary in the transaction relative to the buyer and the reset of economics and the longer duration of the asset. And so in a way, an LP say, well, this isn't what the terms of the original agreement were, and so we find this a very difficult transaction to digest, which is why I think it took so much time for this type of transaction to really evolve and become more mainstream, because it does have a lot of conflicts. And then for the GP, again, is it sort of the right avenue to pursue that's in the best interests of the LP returns, or is it because the GP doesn't want to give up their carry interest and sees more growth in their carry possibility as a result of this CV? So I think that's where the conflict lies. And then also the buyer coming in, they're giving fresh capital, they're slightly maybe diluting the LPs as part of that process. So those are just some of the conflicts to mitigate amongst others, but there are a lot of legal considerations in these transactions, which you probably would have a very good view on. And I think that's really the reason why it took so long for these things to become more mainstream. But again, they're getting more standardized, and so LPs kind of know what to expect and know what are the terms that they should see that are fair to them and to the GP, right? So, but there's a lot of discussion, and these things take longer as a result.
Mm-hmm. And when you are advising an LP coming to the market for its first secondary transaction, what are the main points to be taken into consideration?
So there's a few. I would say speak to an advisor early. You don't have to mandate them, right? You don't have to link arms with them, but you do want to understand the market. And so don't be afraid to reach out to agents. A lot of the times, we give details about the market and we speak to groups all the time, and it might be 2 years down the line that they actually do a sale. So speak to an advisor early, understand the approximate pricing of the funds, the best way to structure the portfolio that you bring to market. Is it a single portfolio buyer? Is it a subset of buyers? Is it different asset classes? Sort of how do you mix and match the portfolio to yield best pricing? And so that's kind of a big one. And for us, like, let's say we don't charge for that service, so take advantage. And then the other one is checking LPAs for any transfer restrictions. So knowing if there's a ROFR or a ROFO and what timeline that runs or that it's supposed to run for will really help you understand the timeline that's required for the sale, and then the structure of the potential sale process. So that's, we often recommend groups check their LPAs on the funds that they're considering. And then understand your priorities. Is it maximizing cash proceeds and get the cash as quickly as possible? Or could you sort of provide seller financing in return for a higher purchase price in the form of a deferred payment, payment of the purchase price over time? And then, of course, the reason for the sale. Are you looking to really understanding the reason of the sale? Are you looking to offload unfunded commitments? Are you trying to crystallize a gain? Is it alleviating administrative burden to streamline the portfolio? Is it really unlocking capital to manage liquidity? Maybe it's managing allocation, in which case perhaps you can get the fund off your book, but do a delayed purchase price, right? Significantly delayed purchase price, where you can bump up the ultimate purchase price quite a bit. And then I think lastly, determining the type of transaction that you might be open to, is a full sale the right approach? Maybe looking at a preferred equity transaction where you retain some upside. Maybe it's a NAV loan instead of actually a full transfer of the ownership of the interest. Or maybe it's sort of utilizing balance sheet assets or portfolio of assets to seed an SMA or to seed a third-party managed fund or another sort of affiliate business that you can seed with that portfolio of assets. So there's a multitude of different ways the secondary market can help structure a transaction. And I think it's, first of all, being aware of all of those transaction types, but also understanding which one is right for you, because maybe a full sale is actually not the right path for what you're looking to achieve. So those would be probably the main points.
Now talking more about the market, if you could compare the sentiment vis-à-vis secondaries now vis-à-vis 2 years ago, what would you say?
It's exciting because we continue to see increased velocity in the use of the secondary market over the last 2 years, and there's no doubt in volume increases. I mean, going from around 106 billion in 2023 in total volume to between 155 and 160, depending on which advisory report you read, billion in transactions in 2024. And I think we're likely to see above 200 billion for 2025. We did our half-year report, but I know everybody's anxious to see the full-year reports from all the advisors. But again, I wouldn't be surprised if we're over 200. And I think there's really 4 major shifts that have been building over the years, but have really come to the forefront. Which is for sure the increased use of GP-led deals and CVs. Now they're pretty much half of the market. In 2023, for the Sutter volume report, we noted it was around 60% in LP-led and 40% in GP-led deals. And then you look at 2024, where it was around 43% in GP-led deals. And then I know some advisors have started to publish already their anticipation for 2025 that it's going to be pretty much half. And so that's a big development. The rise of the broader adoption and the capital coming out of evergreen funds, right, and the setup of all these evergreen funds. If you look at Secondary Link, which is sort of the news and data platform, right, for secondaries, they have detail on around 74 active evergreen vehicles. Spanning various geographies and asset classes. And if we look at just the, let's say, US evergreen vehicles, they sit at the end of 2024, they sat at around 400 billion in AUM. It's a lot of dry powder to be put to work. And not all of them are secondary focused, but a lot of them are secondary focused. And so that's a lot of capital and a structure that really is starting to get adoption both from institutional clients as well as retail and sort of private wealth channels, although it's not yet perfect setup for retail clients, but it's going in that direction and expanding in that direction. So I think it's exciting. And then, the third one would be programmatic sales by LPs. It's the wider adoption in using the secondary market proactively. It's no longer for LP sales. So we do see a lot of endowments, pensions, insurance companies that are just, saying, okay, this year we'll do a sale, next year we'll do a sale, the year after we'll do a sale, and it's planned and it's kind of part of the ordinary course of business, which really was not the case, even 2-3 years ago, it was not the case. Now it's much more widely adopted. And then last mention, I'll say, this is a smaller part of the market, but it's very quickly gaining momentum, is the rise of venture company direct stake trading, right? So minority stakes in VC-backed companies, pre-IPO companies, et cetera. We have a whole team that's dedicated to that, and they've been exploding in growth. I think a lot of the family office network and angel investor and VCs are really tapping into that option for liquidity and ability to participate in deals.
And in the last few years, you have seen an increase in terms of interest rates, slower fundraising. Has that impacted the secondary market or not? Or what are your views on this?
I think historically, the notion was that secondaries do well in times of great volatility or times of general economic slowdown. Of course, sort of given the dry spell and significant slowdown in DPI across alternatives or private capital funds. But I think that's starting to change. And with the more mainstream adoption of secondaries, I think it's not just a tool for a difficult market where there's no exits or M&As dried up or interest rates are too high. But I think it's really become just another toolkit, like a tool in the toolkit that portfolio and asset managers can turn to regularly, whether the market is doing well or poorly. And it's because it's not just liquidity driven, right? And if you look at fundraising, it's actually been great for secondaries, despite the general slowdown in fundraising. Secondaries, I think it was Secondaries Investor that reported by Q3 of this year, total fundraising volume for secondary funds has already outpaced total 2024 volume. So it was around 97.5 billion in 2024 for the full year, and it now sits at almost 133 billion, and we still have another quarter. So money has been pouring into secondaries, and again, I think the expectation is that markets will improve. Interest rates are coming down, but there's still a lot of capital inflows into secondary strategies, solidifying the idea that it's not just a tool for a difficult market. It really is a tool for any market as a portfolio tool.
And continuation funds are really making the headlines. So what do you see those type of funds going next for the next few years? So the evolution of the market.
The evolution of the GP-led market or the LP-led market?
Yeah, so both indeed. So
I think for GP-leds, I wouldn't be surprised if it becomes on par with LPs, even when IPO and sort of M&A markets improve. I do think we might see CB squared deals going forward, like CVs of CVs. We've already started to see them. The processes will become more standardized the more groups that do this. And then I think there'll be continued specialization of groups. So, specific funds will only focus on single asset deals. Some will only on multi-asset deals. Some will do both. So we'll just continue to see specialization and almost subdivision of different asset classes to where they're going to become their own asset class eventually, I think. So that's kind of in terms of GP-led deals. For LP-led deals already, we see more programmatic sellers rather than liquidity-driven sellers. If we look at all the deals that we've done for, let's say, to date, definitely less than half of them, maybe only 20% of them are liquidity-driven. All the others are kind of for various reasons. And we'll continue to see, I think, traditional, let's say, private funds, primary funds, setting up secondary strategies as well. I think that's going to be a big move.
In terms of secondaries, are there any misconceptions that you wish to address about that?
I think the fact that secondaries is only a liquidity or a non-performing asset tool is a big one. Still, a lot of people think that that's the only use for the secondary market. There's a plethora of reasons why, again, some of the reasons I mentioned above for why somebody might use the secondary market. The other one is there is misconception a little bit that it is straightforward when it comes to LP transactions, which I would say is a bit of a misconception. There are nuances, and there's a lot of ways that the process can fail simply because it wasn't timed right or because the steps taken were not done in the right order. So there are nuances to every process. But having said that, it is becoming more standardized, right? So I think it's going to be more straightforward in the future. And then I think the last one would be that you don't necessarily need a secondaries law firm for the deals. I think you should speak to somebody who has a secondaries experience in these transactions. There are, again, you could probably speak to this more, but there are nuances particular to the secondary market that are not necessarily market in corporate M&A.
Sure.
And so having a group that has secondaries background is often very helpful for the process, both in terms of expediting efficiency and certainty of close.
And to conclude, Kristina, are there any books, podcasts, or material that you would advise if you want to learn more about secondaries?
Well, I'll be biased. I'll say Women of Secondaries as the podcast. But really, and not just because it's something that I host, but because there is a lot of really incredible insights that the ladies have shared in terms of understanding the market, in terms of understanding evolution, terms you have to be mindful of, et cetera. There's just a lot of value and knowledge housed in them. And then I would say Secondary Link is an excellent resource for sort of all things secondaries, whether it's research papers, white papers, data on evergreen funds, also video podcasts on all the things surrounding secondaries. There's a lot of nuanced topics such as carry rollovers in GP-led deals that are taken from the perspective of a GP or from the perspective of a legal firm or from a secondary buyer, right? And so they really dive into the different opinions, which is really, I think, important not to just see it from one perspective. And then I also really like Blackstone University. I don't know if many people have gone into that, but it's an excellent resource. They have not just on alternatives, private capital, they have all the topics related to sort of alternative private capital markets, and they're very good detailed papers on there as well.
Yes, indeed, you are doing really great work with Women of Secondaries. So I recommend to the audience to have a look or to listen to the podcast. And thank you very much,
you.
Kristina, for your time today, for your insight. It was really great to speak with you, and thank you as well to the audience for tuning in, and see you soon for next fun expert talk. Bye bye.
My pleasure, Michael. Thank you for having me. Take care.
Our pleasure.
Bye-bye.
Cheers.